Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. And on this podcast, we cover all topics of multifamily investments, from buying and financing properties, day-to-day operations and management, and also reinvestment strategies. First, I want to remind some of the newer listeners, perhaps this is your first visit here. We have a whole bunch of back episodes we did last year, all through last year. And I encourage you to scroll back in your podcast application and take a listen, as we've got some great topics with some great guests like we do today. And I think you'll enjoy those. When an apartment owner has a building or say more than one building for a long time, perhaps they're self-managing. At some point, they usually want to retire from that type of asset. Perhaps they don't have children that could maintain the family business. And this hopeful retiree certainly will need to exit their apartments using a 1031 exchange to avoid that huge tax bill. And a popular destination for that kind of 1031 exchange is a single tenant net leased investment, commonly called a triple net, which is the kind of the street name for these type of assets. And triple net actually describes the type of lease that the property is under, and we'll discuss that a little bit too. Today, we have with us Michael Matter, who is a director in the Stan Johnson Company's Newport Beach office and leads a team of pros that assist investors with acquisition and disposition of this very product type on a nationwide basis. Actually, Stan Johnson Company is a national firm with 16 offices spread out around the country, and they've been specializing in this single tenant net lease space since 1985. Michael began his commercial real estate career in 2004 as a multifamily broker in Marcus and Millichap's Long Beach office. In the last 17 years, he's gained experience transacting across all product types before narrowing his focus and becoming one of the top producing net lease agents in Southern California. He earned a bachelor's degree from Occidental College in Los Angeles and is an active member of the International Council of Shopping Centers. Michael, it's great to have you with us today.
Well, thanks, Eric. It's good to be here. I appreciate it.
Good. Looking forward to digging into some of this. So, Michael, many of the listeners out there, they've heard in some form, fashion, or another about single tenant net lease investments. But let's bullet point the benefits. Let's say we've got somebody new. Maybe they are an older retiree apartment owner, tired of the tenants, toilet, and trash scenario. What would be your elevator pitch for this product type for somebody who's really never looked at it?
Well, I try not to pitch as much as educate because it's not for everybody and there is risk to it. But net lease properties, triple net lease properties are properties where you're not responsible for taxes, insurance, common area maintenance. The difference between owning an apartment building and a triple net lease property is night and day. Net lease property, essentially, collect a check and that's it. And the management otherwise is minimal. You don't really have much to do. The tenant is responsible for all expenses related to the property. Basically, your most passive ownership of commercial real estate.
So certainly the net lease market has been around for quite a long time. But can you tell us how that product type has evolved maybe over the last 5 or 10 years, and kind of what's been the paradigm shift there, if there's been one?
I think the big change probably in the past 5 or 10 years is just the maturation of the product type, 10, 15, 20 years, whereas there was a lot less capital chasing net lease properties 5, 10 years ago. It's really come to its own on all levels, institutional, private. There's capital from all directions chasing net lease properties. So it's really matured a lot more. There's more lenders for net lease product. Looking to place debt on net lease product. There's more buyers, there's more service providers, there's more brokers, there's more everything. So it's really just matured and caught up with some of the other more mature product types.
Yeah, I'm noticing that. I've got a client right now who's about to enter an exchange to get out of some apartments, and he's heavily looking at the single tenant product. And before I perhaps get him over to you to dig into it, I was just scanning the available listings on good old LoopNet, and it really has looked like the cap rates have compressed on those, at least since the last time I looked. Are you still in a cap rate compression zone right now?
Absolutely, and really cap rates have compressed, over the past couple of years, and values have gone up. Like a lot of commercial real estate or other types of real estate, quest for higher yield, the quest for yield, the quest to move geographies. There's a lot of different motivations for people to acquire products. There's a lot of reasons for people to sell apartment buildings in states like California and New York. Sometimes there's local legislators have passed legislation that's negatively impacted them. And then there's, where do we take the money? If I want a 1031 exchange, what do I do? And a lot of times investors that are more senior and want to retire and get out of management, they don't have to be senior to want to get out of management, but to get out of management, net lease property seems to be the path that they like to go down.
Great. So traditionally, when I've looked at these on behalf of an apartment owner, they're looking for a pretty good term and lease. And obviously you see those out there ranging from, could be the lease has got only a year or two more on it, or you could have, say, like a fresh brand new lease on a brand new building. Give me an idea, for example, on a couple of the bigger name credit tenants on a given property in California versus somewhere else. I mean, give me maybe a little spectrum on cap rate and what we're looking at if we can find the right deal.
It's I think post-COVID, the cap rates have really compressed various parts of the country. There's a lot of cap rate compression between the major markets, coastal states versus kind of flyover country. You don't get that much of a premium anymore from going out of state, from major metros of New York and California to buying in a state like Indiana, Oklahoma. There is a spread there. Don't get me wrong, but the spread used to be a lot wider than it is now. It's compressed quite a bit. So, for instance, you can sell a 7-Eleven convenience store in California for a 3.5 cap. You can go buy that 7-Eleven convenience store in secondary market in Texas for probably a 4 cap. You're getting maybe a 50 basis point swing on your cap rate.
So that's very interesting, because I do remember when I would compare and contrast like a California single tenant versus, like you're saying, Indiana, Oklahoma, there'd be maybe a 1 point cap rate difference between the two. Could even be a little bigger depending on where the thing was. What I'm hearing you say is those out of state or tertiary markets, the cap rates have compressed faster than they have here, to where that spread is now very minimal compared to a couple of years ago.
There's been so much capital outflow out of California, where we're at, the middle of the country, that it's compressed. I don't want to say it. Of course, it varies. If you're in a super tertiary market, less populated state with a medium to low credit tenant, the spread is a lot wider. So I sold a Hardee's property just recently in a small town in Indiana, and it sold for a 6% cap rate. It had low sales and it had a franchise operator. That property, being Hardee's and Carl's Jr. being essentially the same beast, that Carl's Jr. property here would have probably sold for 4.5 cap. So in that instance, it's a 150 basis point swing. It really depends the product type, quality of the guarantor behind the lease, how much term is on the lease, and then what kind of market it's in. Is it a dying tertiary market in the Midwest? Is it a micro market that has positive demographics? All these things kind of play into value, should be paid attention to for buyers looking to acquire property.
No, that's a good point, and it kind of dovetails into my next question, playing devil's advocate for a minute. I mean, we know any type of investment, save for maybe putting your money in a ridiculous savings account, they all have a risk factor. What are the biggest pitfalls to look out for when you're considering a single tenant product? Starting with perhaps business sectors, where would you guide your client on, say, product type and the mitigation of overall risk past the product type?
It changes with economic conditions and things like the pandemic. Prior to the pandemic, the concern was being e-commerce resistant. Payless Shoes is a dying brand. I don't want to buy a single tenant Payless Shoes, before the pandemic, because Amazon's eating their lunch and retailers like that. Whereas prior to the pandemic, also restaurant service oriented businesses were bulletproof. Restaurants were bulletproof because they're Amazon resistant. They're experience driven. But the pandemic came and beat up sit down dining. Drive-through dining went through that unscathed because they purchased through the drive-through, and you don't have to worry about contact spreading disease as much through a drive-through. So drive-throughs fared a lot better, and the cap rates actually got lower for that product type. And then essential services, during the pandemic, you remember that term, what's deemed essential, what's not deemed essential. There was kind of the picking of what was essential. Some tenants like Dollar General's a fantastic credit. Properties are located in the middle of nowhere, highly tertiary markets, but they sometimes are the main kind of general store for those little markets. They weren't going to close down. They were essential, and they have this great supply chain logistics situation, Dollar General, with a long established brand with thousands of stores and distribution hubs. So they were were very important in being able to serve some of these small communities in the supply chains during the pandemic. So investors really were drawn to Dollar General as their stock value increased, as their credit improved, and as they became essential through the pandemic. So those cap rates went from 6+ cap rates for new builds to now we're seeing 5%. We're seeing put on the market sub 5%, and they're still attractive to investors. Convenience stores also were another big winner out of the pandemic. 7-Eleven did really well. Drive-through fast food. Those are the essential retailers are the ones that came out of the past few years looking good.
Yeah, definitely a paradigm shift with what we've experienced the last couple years. I think their biggest fear, out of state may be new to them, but if you can overcome the idea of, hey, look, it's a net lease, you don't really have to go there. I've got one family that bought a couple of single tenant products 5 years ago. And I talked to the fellow the other day, and they still haven't ever been to it to like go have a taco at the Taco Bell that's sitting in there. He says, I just don't really need to. The money comes in through wire. My loan payment goes out through wire. And I don't need to go to Newcastle, Oklahoma and have Taco Bell. But I think in the same sort of vein as that, you have a fear of, okay, out of state, fine, we got a net lease, but what about the vacancy? In my apartment building, if I lower the rent to the right number, I can have it leased in one weekend. Whereas, oh, wow, how long, if this thing went dark, how long would it sit dark? And I guess the location thing is ultimately the factor.
All the risk factors are things to be cognizant of. And owners that own apartment buildings are used to owning apartment buildings. Looking at a single tenant, it's the low-hanging fruit as far as risk. Yes, you're buying multi-tenants versus single tenant. You're buying a retail tenant. Properties stay vacant a long time, a lot longer to lease a retail property versus an apartment building. Those are valid concerns. Along with many other concerns. And oftentimes if it's a single apartment owner that owns one single apartment building and their entire nest egg is in that apartment building, I really try to qualify them before I advise them to go buy a triple net property, depending on where they're at in their life cycle. If they're 80 years old, marginal health, want to get out of the apartment, ride it out in a high credit long-term lease, I can probably advocate for that. If they're going to outlive their lease term and go buy a single tenant deal and they have one apartment building, you have to be careful. Make sure you're buying a good deal. Buying a good location matters, like all other real estate. If you're talking about retail net lease properties, location definitely matters. Are you on a signalized hard corner? Do you have a decent sized lot? Can you replace that tenant? Can you replace the rent if they go away? Certain tenants like Walgreens try to pick the best locations in town, main corner. Those are good locations to buy, but they also pay an inflated rent. Can you replace those rents? Paying attention to what kind of rent they're paying, paying attention to what the fundamentals of the location are, if there's intrinsic value. When the lease was executed top of a peak market where building materials, land costs are also peak, odds are they're going to be paying a higher rent. There's deflation in any of those factors down the road, then go away. That becomes tough to replace the rent. So paying attention to where the rent is, paying attention to on more seasoned locations, what the foot traffic is at those locations, what store sales are, if they report the store sales historically. Fast food, for instance, determinant. You want to know what the historical store sales are, various ratios to see how they're performing. Along with that, there's other aspects. When you go buy a property like this, people try to cut corners, avoid working with real estate attorneys to review title, avoid getting overlying due diligence items like renewing, recertifying an ALTA survey or getting a phase 1 environmental report where there isn't one. It's a different transaction model. There's more cost to transacting when you buy a net lease property, typically, unless you're buying a new development and all reports are provided. There's costs to making sure that there's no environmental hazards, neighboring encroachment hazards. The survey helps you to determine that. Those are the real estate related concerns. On top of the tenant, what's their credit rating? What's their business model? How familiar are you with both of those? You should get familiar if you're doing due diligence to exchange into that product type. Obviously, lease term, and there's different people have different ideas on how to approach the business. A player, somebody who's involved in transacting in this space, likes shorter term leases. They like lower rent. They like opportunities where they think they can add value in emerging markets, good locations. The more passive investor, typically looking for longer lease term and credit. Aside from all those concerns, it is really the easiest real estate to own. A check every month or getting money wired in your account every month and not really doing anything. So there's pluses and negatives to net lease versus other product types. Doing due diligence is important. Never advocate for cutting corners when it comes to due diligence.
Yeah, it sounds like it. I mean, you got the investor who we're, hypothetically using is coming out of apartments, knows that product type very well. And on the continuum of due diligence, from my last single tenant I did, it was about double or more of what you'd want to experience in an apartment purchase, right? Because you do have a lot more moving parts. So I guess the moral of the story is the due diligence is way heavier. You've got some factors going on with the single tenant, e.g. the tenant itself, what does the lease look like, and a bunch of other due diligence items that you're really not going to have to study too closely, or if they even exist at all on an apartment complex. But after the close of sale, you have the easiest property to own once you've done your homework the right way.
And due diligence varies, and I guess it depends. For instance, you're buying a Dollar General, you're selling an apartment building, buying $2 million Dollar General in Texas. I'm selling one right now in Texas, in the middle of nowhere, small town, South Texas. Do you need to fly out to that small town in South Texas and go look at the real estate? Back to your original question, it's not important to most people. I'd say 30% on a long-term lease, credit tenant. They understand the business model of Dollar General being in the middle of nowhere. They understand the credit. Do they need to go fly out there and go make sure it's a top location with a population of 800 people? It is what it is. The demographics are what they are. You're going to fly out there. It makes people feel warm that they went to go see the real estate they're buying. Some people do that. Some people don't. If I'm buying fast food, I want to go survey the market and see what the retail trade area is like, what the competition's like, look at the, verify traffic. I think it makes more sense to visit the property, but everybody's different.
I got one more question for you in just a second, but first I'll tell you about our firm, WSC Realty Advisors and WSC Property Management. WSC has been helping buyers and sellers and managing properties in Long Beach for over 15 years. If you're tired of managing your units, kind of like we're talking about here, or just not getting the results you want, we can definitely help. WSC never wants to be the biggest firm in Long Beach. Instead, stay small and more agile to bring the quality that you need. We can also help you if you're looking to acquire more apartment units out of state, or here, if you're looking for more units. Visit WSC-PM.com. Call, text, or email us. All that's in the show notes. Mention the Everything Apartments podcast and get your first 2 months of management absolutely free. Whatever your challenge with your property, WSC has the solution. So, obviously over the last few years, the term DST, or Delaware Statutory Trust, popped its head out of the ground, and it's got an interesting comparison contrast for the retiring apartment owner to perhaps move into that vehicle. Give me, if you were sitting next to a DST broker and you're both talking to our apartment retiree, what would you communicate to him as the differences owning in a single tenant versus being part of a DST?
Yeah, DST is acquiring a share of a kind of institutional level property managed by institutional level management, where you're buying shares along with a bunch of other investors post closing. So they've already closed the real estate, they've already placed debt on it, and they're selling a percentage of the property to you as an investor. And it came out of the 2008 recession. I don't know if you remember, before that we had TICs, and the DSTs are a more regulated version of the TICs. A lot of people got hurt with the TICs. There was a lot of problems with those during the recession, and the DST is kind of what morphed out of that, being more regulated. I think DST is good for some people. You are in a co-op situation. You're owning a piece of real estate with a group of other people. There's the less control aspect. DST asset, it's sponsored by K Properties or Inland, or there's some good sponsors out there. There's a handful of really good ones with great reputations. As important as the real estate is, who's the sponsor behind the offering? You have to do your due diligence on the sponsor, find out who the sponsor is and what their credibility is. You do due diligence on the real estate, and you can look at what they present to you. You can only obtain so much due diligence information, but they've already had an institutional level due diligence. They've closed escrow on the property. You can feel good about that. They place debt on the property, so you don't have to be a guarantor on debt. I think that's great. People with funky debt situations on their down leg properties, DSTs end up making a lot of sense. Big drawback is you lose control, but you're not liquid in any commercial real estate per se, but you can't refinance your DST and pull cash out to buy something else. You can't buy out a partner, and then you're kind of subject to what they want to do with the property. When they want to sell, you're selling. You have no voting rights, and that was something that came out of the recession. As a limited partner in a DST, you don't have any voting rights. They make the decisions, and they have to make decisions, good decisions. They're regulated and they have their fiduciaries, but again, not your decision and as the investor, it's their decision. Sell, you have to go 1031 into something else. Could be an inopportune time for you as an investor in the DST. And net lease, you maintain control. You maintain control of debt that's placed, pulling debt from the property, having that, so a little bit higher level of liquidity, obviously more control in that you own a single property yourself. You're doing the due diligence yourself. I advise investors to buy DSTs sometimes, depending on where they're at, how sophisticated they are, how much money they have. If somebody has a small amount of money, I know what the landscape's like in the net lease world across the country. And if you have $200,000, $300,000, $400,000 to invest, you're not going to buy a good net lease property. The DST is better suited if you want a triple net type property. I would recommend buying a DST. And that maybe even up to $500,000 or $600,000. I might even recommend DST. But the cool thing about DSTs, triple nets, and all of it, and the debt exchange process is you can identify both, and you can do due diligence on both, and then you can make a decision to identify DSTs as a backup option if the triple nets don't work for you. If you're not liking what you see, you review both during the process, and if you're okay with ownership styles of both.
Excellent. Well, Mike, thanks for visiting with us today. And for your listeners, I'm going to have Michael's contact information in the show notes. I highly recommend him if you're thinking about this kind of product type at all. If you're thinking about heading toward a 1031 exchange on your apartments, obviously first call me. I'll sell those apartments at the highest price, get you over to Michael so that he can open up the landscape, show you some possibilities of what you could do with that exchange. And again, I'll have his information in the show notes. Michael, I really appreciate you being here with us.
No, thanks, Eric. Happy to help. Thank you very much. I appreciate it.
Thanks again for listening to the Everything Apartments podcast. Again, I'm your host, Eric Christopher, and stay tuned for another episode coming soon.